Former Treasury Secretary Hank Paulson has called on U.S. authorities to draft an emergency contingency plan for a potential collapse in Treasury demand. When you see the former Treasury Secretary say there's going to be a collapse in the Treasury yield, or Treasury market rather, the demand for it, yield will go to the moon, we should all think very strongly about his words. He's no longer in the limelight. For him to say that, he must really, truly believe it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Monday, April 27th through Monday, May 4th, 2026, while supplies last. First this week, 1 ounce U.S. Silver Eagles are just $5.75 over spot per ounce, the lowest premium we've seen on Eagles in a long time. MS62 $20 gold Liberties are just $99 over melt per coin. And finally, we will swap 3 nines fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm always glad to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us for this weekly market update. Today is Tuesday, April 28th, 2026. Andy, thank you for coming back on Liberty and Finance.
It's good to be here, my man. Thanks for having me.
We missed you last week when you were on business travels, but glad to have you back home safe and sound. Thank God for that. And our viewers and subscribers bug me during the weeks when they don't get to see you saying, "Where's Andy? When's Andy going to be on? What are you going to talk to Andy about tonight?" So here we are, and we get to have your update on the things that you're watching most closely in the precious metals supply chain, but beyond that, in the global financial and monetary and geopolitical sphere that will likely have knock-on repercussions in all of our lives financially. So if you could give us your Andy's big picture overview of what you see going on right now and what you're watching closely.
No, there's so much going on, Don. Again, it's so hard to pick any one, but some of the things that I noticed over the weekend, as of yesterday, I haven't seen the numbers from yesterday, but as of Friday, we saw a lot of open interest in silver, 135 million ounces of open interest. Those are contracts that are still out there that could stand for delivery. The first day of the May delivery contract is this Thursday in 2 days. 135 million ounces of open interest with only 77 million ounces of silver available for sale. That's a problem. What could possibly go wrong? Now, typically what we see is the open interest decline precipitously into that first day of delivery notices, and I'm sure we'll see that again. But the point is we're getting closer and closer and closer to a moment where there's a real problem with delivery. At this point right now, we don't have to signal the alarm bells, but what I am saying is that the COMEX and the CME group, I think, are losing trust, and you can see that by the precipitous drawdown that we continue to see, the deliveries, and many of these deliveries being sent out of the COMEX. We talked about in February, 39 million ounces left COMEX, but only 26 million ounces were delivered that month. So 160% of what deliveries could explain alone left the building. Now, again, there is still a couple days left, but here again, this is something we've been seeing every single month where the open interest dwarfs the amount of silver that could be delivered behind it. And it's getting late in the cycle where there's only 3 days left before these delivery notices come out. Something to keep an eye on for sure. I wanted to talk about something that I saw regarding stablecoins and blockchain and the Genius Act. Before I get there, we'll finish with a little bit of talking about gold and silver. I think I probably spoke about this with you last time we were together, but just in case, we saw the price of silver get hammered in February and in March, yet we saw unprecedented January and February and March. Unprecedented demand for silver imports into China, 78% over a month-to-month pattern. So in other words, surging almost 80% month over month to a record 836 tons in March, which was 173% above the 10-year seasonal average. That was the all-time high in March. February was the all-time high before the March numbers beat the February numbers. So as the price of silver got clobbered, February and March back-to-back were the two biggest imports numbers into China of silver in the history of import records. So here again, they've already imported 1,626 tons, the highest level on record. So in 2025, China was a net exporter of silver. In 2026, they are now a net importer of silver. In November of 2025, they came out and said, we are the second largest producer of silver in the world. We will not be sending any of our domestic stockpile out into the global market. And then in January, kind of pushing back against the classification of silver as a critical mineral, they came out and said, we will start to curtail exporting. They're one of the largest refiners of doré bar in the world. And so here you see, coinciding with a slowdown in exports, not going to send out any of their domestic consumption. They imported more in January, February, March, back to back, higher than they ever have before. And I think when we look at the pullback that we saw recently, where silver is just massively underpriced in the respect that the pull down in the price of silver, according to the Bank of International Settlements, was completely, it certainly wasn't fundamental whatsoever. It was more structural. BIS said it was totally structural, where you had the rebalancing of the levered ETFs that happens the first or second week in January every year. It's notorious to see all sorts of volatility in all kinds of commodities and indices, because these ETFs, as a mandate to their prospectus, must rebalance after weeks and weeks and weeks in December and January, November and December, of silver continuing to go higher every week unabated. These ETFs, these massively levered ETFs, got way out of whack according to the prospectus. So they had to be rebalanced, along with the margin increases of 300%. Was a synthetic orchestrated collapse by the CME group. The worst time to raise margins when you have rebalancing of the ETFs. And that's kind of what the letter said that the BIS put out. And that's why you're seeing, I think, banks like in Switzerland who came out and said, I forgot the name of the bank. It's one of the big ones, but it's not UBS. It's not a name you hear very often, but they came out and said, we sold into the structural decline and bought back once we realized it was not fundamental. You're beginning to see, I think, the realization that this was an orchestrated collapse. And when you look at it that way and then see during that collapse that China imported more 2 months in a row, really 3 months in a row, than it ever before, and become a net importer, it's a big deal. It becomes an even bigger deal when you realize that the margin increases flushed out all of the speculative froth. It also flushed out a lot of speculation in the retail industry, which really isn't driving this market, but yet a lot of people freaked out and sold. And I think the bottom line here is that what you are seeing or witnessing in real time is a very strong base being built under those who are holding metal right now. The speculation is not there. It is the people holding it for the correct reasons, and will, I think, provide a very stable, solid base for the next leg up. I think that's a big deal, something to certainly consider. I wanted to talk about, by the way, they did just reduce the margins on silver by 21.4% from where it was, gold by 14%. So they realized that they flushed everyone out, so they're going to lower margins now, and they shouldn't have raised them in January, right at the same time they were rebalancing. You were guaranteed to knock the metal down. Couple of other things before I get to the stablecoins. Interest payments on the U.S. debt, we all know it's set to surpass $1 trillion in 2026. $88 billion a month, equal to spending on defense and education combined. We've all talked about that. Something I didn't know, found interesting over the weekend. There is something called Ferguson's Law, and it says an excess of debt over defense is a violation of Ferguson's Law. Ferguson's Law states that any great power that spends more on debt servicing than on defense, risks ceasing to be a great power. This is because the debt burden draws scarce resources towards itself, reducing the amount available for national security, leaving the power increasingly vulnerable to military challenges. That's the case. We know that. And military spending is discretional. You have to borrow it. But it's interesting. The article went on to say that the Committee for Responsible Federal Budget estimates that just a 1% rise in interest rates on the 10-year Treasury from an average of 4.3 to 5.3 would add about $3.5 trillion to the U.S. debt over the decade. We are at that point where these numbers are getting to be very, very, very big and very troublesome. And those people who say that the debt doesn't matter to the United States are missing a very big picture. And that's why you're seeing rates go higher, because countries are selling treasuries, which is very unusual, because every war that we've ever seen that involved oil, which raises the CPI, which raises inflation, would say, just like we're seeing right now, the fact we can't raise rates. We certainly, we can't do that because, we can't lower rates rather, because, the inflation is heating up so much. If we lower rates, you're going to reignite and add fuel to the inflation fire. And therefore gold and silver can't go higher. It's just a stupid argument, because in 2019, with $1,800 gold and zero federal funds, we watched it go up 450 basis points in a year, the highest, sharpest increase in history. And yet gold is triple from where it was back then, nearly. Again, a convenient argument that is stupid and makes no sense. A couple other things I wanted to talk about. The media made a big deal about the Central Bank of Turkey selling its gold last month. They are quiet right now in the respect that they are now rebuilding their gold reserves, and they've added a whole bunch to their stock. They added 30.7 tons over the previous week, bringing their total gains to 36.4 tons, and reversing this drawdown driven by earlier liquidity operations. So again, they'll tell you when it's convenient. They'll say rising interest rates is bad for gold and silver. Now, that's Gibson's paradox. To a degree, it is. But I would argue that the mistrust or distrust of the dollar, of the Treasury, of our geopolitical aspirations, of our political environment, of all of the irresponsibility we've shown fiscally and monetarily, that people don't want our treasuries right now, and rightfully so. And therefore, as rates continue to move a little bit higher, it doesn't incentivize people to jump back onto the sinking USS dollar. So anyways, I found that to be very interesting. The one thing I wanted to talk about that I find very interesting is the concept of the surveillance state. I had Catherine Austin Fitz on, as you know, and I was on her show, and we talked about this. And we talked about a central bank digital currency, and we talked about a new system that the Genius Act confirms, and that is money moving on a blockchain backed by U.S. treasuries. Talked at length about how that creates synthetic demand for the U.S. Treasury in an environment where there is selling of treasuries, a la rates going higher, as we've seen since the beginning of the war. The Genius Act, once it's fully enacted in January of next year, will be backing any money movement in dollars across the globe with short-term treasuries, which creates synthetic demand for the front end of the curve. Therefore, any talk of Warsh, the new Fed nominee, to him being hawkish is silly, because he'll be neutered in the respect that money moving synthetically will drive and pace the front end of the curve down to the floor. There's nothing he'll be able to do about that. But what I wanted to talk about was Tether. Now, Tether, USA Tether, I've talked a lot about Bo Hines, their CEO, Trump's previous crypto czar. They're already Genius Act compliant. Now, one of the things Catherine talked about was, people let their guard down when it's a stablecoin issued by a private entity like Tether, not a central bank digital currency. She said it's almost as bad or worse because the guard is down, and that the plumbing of the Stablecoin Act will run through both ways, in and out of the Treasury. They will control, in essence, the on-ramp and the off-ramp. And so this is something that concerned her. Now, when I've mentioned, by the way, you have the digital ID for voter integrity, She said, yeah, you add the digital ID and a digital form of money, you have entered the surveillance state, believe it or not. Now, I'm going to show you how she's right. And it's actually kind of freaky and bothers me and should bother all of you. And this is one of the reasons that you want to own gold. Now, I'm going to show you two examples, one spot on and another one a step or two removed, but nonetheless scary as can be. On April 24th, just last week, Tether confirmed that it blocked 2 wallets on the Tron network worth $344 million. One held $212.9 million, the other held $131.3. U.S. officials linked both wallets to the Central Bank of Iran and local cryptocurrency firms. Authorities flagged the funds as tied to unlawful activity. Chain analysis told CNN the 2 wallets were regularly active years ago and engaged in frequent large transfers of up to tens of millions of dollars, largely with other private wallets. The firm said those patterns are consistent with how we've observed other known IRGC wallets move funds on chain. Okay, number one, they can monitor what you're doing. They know who you are and who you're trading with. So that would be AML, anti-money laundering. They know, who you are, where the money's come from. KYC, know your customer, and KYT, know your transaction. Now, we know that's all embedded into the stablecoin technology. So here's a firm that can say, yeah, we've seen these 2 wallets. We know that they're moving back and forth. This is how IRGC wallets have moved in the past. They know who you are. They know what you're doing. They know how much money you're moving. There is no anonymity. The 2 wallets were blacklisted at the smart contract level, meaning these tokens cannot be moved. So yes, the frozen with a command framing is essentially correct, is what they were saying. And so in essence, they froze the money of the Iranian entities that were trading stablecoin over this network, and everyone thinks everything is so private and so much anonymity. This is what Catherine was saying. The money moves in and out of the Treasury, so they can see who's doing it and they can stop you. Tether works with over 340 law agencies across 65 countries and has frozen $4.4 billion in assets overall. One question now stands out. Can governments control money on a system meant to be free? The answer is yes, they can. And so when you think about in January, everything moves to stablecoin, and you have now this new this new legislation where they are trying to make, according to the Clarity Act, all these crypto exchanges regulated on par with banks. And so there is no freedom anymore in money movement. And if things were to get much worse with the digital ID and digital money, and you do something that the authorities don't like, you too can be shut off from moving your money. This is where it starts to get a little scary to think about. Yes, if they can do it to these wallets, well, they can do it here if you're doing something untoward. Now, here's the second part that I found very Orwellian, right? Buried inside the 2021 infrastructure bill is something almost no one is talking about. By 2027, every new car sold in America is required to include driver impairment technology. That means sensors watching your eyes, system measuring your breath, AI deciding whether you're fit to drive. And if it decides you're not, your car can refuse to start, limit your speed, or take control. Now, to be fair, the goal is safety, stop drunk and impaired driving. But let's not pretend that's where this ends, because what this really introduces is a new layer of control built directly into the machine you rely on every day. Your car is no longer just transportation. It becomes a monitoring system. Eyes tracked, behavior analyzed, decisions made for you. And here's the part no one is comfortable saying out loud. The data doesn't just disappear. It can be stored, shared, potentially accessed by insurers, regulators, or whoever ends up inside that ecosystem. Now add in the reality that this technology is not perfect. False positives are guaranteed. You're tired, you had a long day, the system thinks you're impaired, your car won't start, or you're stuck driving 25 miles an hour on a highway. That's not theory, that's how AI systems work. So the real conversation isn't, is this coming? It is. The real question is, where's the line between safety and control? You're starting to see all this stuff where it's one thing to have a digital ID, frame it safety for election integrity. It's another thing to have digital money that knows who you are, where you got money, and what your transaction is. AML, KYC, KYT, know your transaction. It becomes even more concerning when they can freeze your money if they believe that you have done something untoward. Interesting. Kind of guilty before proven innocent, perhaps, or maybe not. Maybe you're guilty and you're frozen. And, what does it take to become unfrozen? And you have these entities that are acting sort of like what you see in the airport. If you see something out of the ordinary, report it. Well, these folks can certainly just do that. So it's not that it's being, just because it's third-party infrastructure building the rails for this, they're running through the proper channels of compliance and security. You get in your car, you've had a long night, you haven't drank anything, you just feel like crap, your eyes are half open, you're not really alert, but you can drive home. Your car says, no, you can't drive home. These things are beginning to happen, and they're concerning, they're frightening. And when we talk about these things, a lot of times people say, oh, that'll never happen, your crazy digital money and, AI doing this to you. I mean, they're going to have sensors that will monitor your breath and sense if you've had alcohol, or sense if you're erratic in your moves or your eye movements, or if you're fixated on one thing for too long. All of this stuff is becoming very scary. We're being monitored everywhere we go. There's cameras at every turn. Your phone listens to you. Now your car is going to listen to you, and your money will be programmable and can be stopped. And that was one thing that Catherine said, was that, the Clarity Act did not say that this money isn't programmable. They left that out. So in other words, they can program rules, and, once you, what did Ben Franklin say? Give something up in the name of security, a liberty in the name of security, something along those lines. You never get it back. Once we cross this Rubicon, these things won't ever come back. I found it very interesting. I wanted to at least think outside the box there. A couple other things, and then I'll take any questions that you have. I know sometimes we haven't talked in a while. I like to just go through interesting things that I've seen. Goldman Sachs is estimating that the oil price shock triggered by the war will suppress payroll growth by 10,000 jobs per month if the war ended today. In other words, they're saying that the labor market is in very, very big trouble, and that's 10,000 jobs per month through the end of this year. Hasn't even stopped yet. We talked about the Shanghai flip, where COMEX saw a massive, or when the COMEX market collapsed, we saw all the deliveries. I put that in there. I think that is going to cover it. Let me just see. It's not just silver. Chinese gold imports rose to 162 tons in March, the highest since March 24. It's the third consecutive monthly increase for both gold and silver. This marks the 17th consecutive monthly purchase. China is still stockpiling gold. And then major institutions are doubling down on gold's upside. Wells Fargo sees a potential move to 8,000 by 2027. UBS, JP Morgan Chase, Deutsche Bank, Bank of America, they're all targeting 6,000 plus in the next 12 months. Bank of America, Michael Hartnett, says the next phase of the decade will shift from stocks to commodities. He's the one who came out and said put 25% of your assets in gold. And BlackRock is doing the same thing. They're pivoting away from their 60-40 portfolio model, the way that the lead chief investment officer of Morgan Stanley did, and they are increasing exposure to commodities, including gold-related assets. Of course, your regular guest, Michael Oliver, he's one out there that is as bullish on silver as anyone in the world. He sees a new reality of between $300 and $500 very quickly, possibly this summer. Couple other, last thing I get, well, two other things. Central banks now hold 18% of all the gold in the world. And I find it interesting when you think about these are the people who print the money are buying the one asset they cannot print. They now hold more gold than U.S. treasuries in their foreign reserves, and that should tell you everything. Period. The deepest pockets in the world are moving out of paper and into hard assets because they see what's coming. I find this one concerning and ironic that former Treasury Secretary Hank Paulson has called on U.S. authorities to draft an emergency contingency plan for a potential collapse in Treasury demand. And he gave this interview to Bloomberg last week, Thursday. He said the plan needs to be targeted and short-term and ready before a crisis hits. When we hit it, it will be vicious, so we have to prepare for that eventuality, he said. When you see the former Treasury Secretary say there's going to be a collapse in the Treasury yield, or Treasury market rather, the demand for it, yield will go to the moon, we should all think very strongly about his words. He's no longer in the limelight. For him to say that, he must really, truly believe it. That's all I got in terms of new info since we last talked. I think may have more that I figured we'd already covered, but happy to take any questions or comments you have on what I brought up.
Just a few notes on what you've already brought up. When you talk about China doing record off-taking of silver and increasing month over month for the past 3 months in a row, all record months, in the face of a smackdown in the price of silver on the COMEX due to a whole bunch of factors all happening interestingly at the same time, it's certainly underscores from a preparedness standpoint the idea that you want to accumulate essential assets at a time when you're able to do so, and not when it becomes obvious and popular and fashionable. Rick Rule has been with us every month for the past 14 years saying the same thing. Is if you are weak-minded enough to have to wait for the crowd to validate your gut feeling, you've missed by far the biggest part of the move, and you might even be at a place where you can't even make the move once the crowd is trying to do it. So from a preparedness standpoint, doing what as you've often said, the most well-informed and well-funded parties in the globe, those at the top of the food chain are doing, follow their example, watch what they're doing, don't follow their words. As you said from years ago, The Art of War by Sun Tzu. So that's one thing that observing there. Another thing, when you talked about the vulnerability of privacy and the potential for control that Catherine Austin Fitts and you had discussed about stablecoin and into how it's tied into your banking and be tied into your technology and your card, everything smart, everything, made me think about maybe a phrase: are the U.S. Treasuries and stablecoins the new financial straits of Hormuz? In other words, they're the choke point and centralized. We've been told all along, oh, this is distributed. That's the glory of the new era, just like the internet was all distributed until it became through the COVID era, these deplatforming and silencing and shadow banning of people who were trying to just do free speech. And yet it was done by private companies, not by the government. So have we seen this playbook before? And then finally, this volatility that's expected on the physical exchanges. We've even heard as recently as today from Rafi Farber about aluminum squeeze shaping up on the exchanges. It looks like it's going to rival or surpass what happened with nickel a few years back, to where it really could be an existential crisis, but this time on a physical level, not just a paper contract level. And then one last note, when you were talking about how we're being sucked unknowingly into this idea of like digital IDs and digital surveillance and everything, I was just getting to the age where I need to start learning some more about Medicare, which will be upcoming for me. So I was just poking around on the website, and I got to the point where it says you need to have an ID, and here's the choices that it gives you. These national ID.me or Clear or login.u or whatever, only these nationally recognized government sanctioned digital forms of identification are going to be the ones that are acceptable. And it's like, oh boy, here we go.
Yep, I don't think there's a way out of it. I think you can do as much as you can to try and keep a piece of your life outside the digital matrix, but it's coming. It's a foregone conclusion. The world is moving in that direction. And what do they say? Resistance is futile, but do the best you can anyway.
Any thoughts from you on this follow-up? Because we've also, you and I were talking before we started about the concerns about what do you really own from people who are holding, for example, stocks on a brokerage exchange. They've come to understand through the book by David Rogers Webb, The Great Taking, that you don't really have legal ownership of shares of the company.
You're subordinate to the custodian in terms of ownership. That is correct.
Right. And then similarly, if you have cryptocurrencies or stablecoins or whatever, it sounds like that's still going to, from a privacy standpoint, going to be scrutinized, gated, and tracked by the Treasury or private companies on behalf of the Treasury and so on. What do we know about returning it back to physical assets, gold and silver, being able to own monetary metals without them being within that completely transparent domain that is completely open to the scrutiny and inspection by the authorities?
Well, I mean, once the payment rails are on that chain, it's going to be hard because everything will be recorded on that chain. Until then, you have the ability, I guess, to pay by check or wire, and it's not on a blockchain. But that's kind of what Catherine is talking about. The anonymity in the name of convenience is the loss of anonymity in the name of convenience is something that people should think about very, very long and hard. Not a lot we can do about it anymore because it's law. It's coming into effect. So, keep cash, spend cash, talk to people about the benefits of cash, have your metal in your own possession, if possible. If you have to store it, it's in an IRA, then so be it. But anything you can do to distance yourself from the matrix, I think is a great idea. Catherine talks about she just keeps enough money on hand for liquidity purposes, for, purchases of day-to-day needs and whatnot, but everything else she keeps outside of dollars, keeps them in the form of assets. And I think in this environment, the dollars is going to face some major inflationary headwinds, and holding your wealth in dollars is like holding a melting ice cube. I don't think it is in your best interest. I'm not telling you to put everything you have into gold and silver, but I do think assets feed you, and liabilities, which the dollar is a liability, they eat you. And I think now, coming up now more than ever, it will be important. The effects that we've seen on the war have not really wrung out yet, because there was so many ships that were out in the seas that were loaded up before this happened that have now unloaded their fuel reserves into these holding containers across the globe, wherever they were being delivered to. So that kind of bridged the gap, but you're beginning to see those numbers start to trend down, and availability in places like Australia, they only have a few days left or a few weeks left of diesel reserves, I was told. And so, you're getting into a point where not only can it affect greatly the cost of goods, but also the profit margins of corporations, which leads to layoffs. You got guys like James Rickards saying, look, you got 20% of the fertilizer components coming out of the Straits, and you have only one growing season, which is now. When you're not properly fertilizing it, your growing season can become a disaster. He's talking about the possibility of worldwide famine as a result of all of this. It's not just the oil and gas, it's the byproduct, not only of food, and you can see that by watching the food indices. And I think I had a breakfast meeting with a very smart trader today, and he said to me, the name is the Invesco DB Agricultural Fund, symbol DBA. It's a blunt tool to track agricultural prices, and he sees it's breaking out. And he says, look, if I were still trading on COMEX, I'd be long on the grains and all of the food items, because it is breaking out right now. And that the fertilizer issue and the fuel issue is something that hasn't really played out yet because of all of the ships that were en route to, drop off their supplies, but that's over now. Even if James Rickards was saying it stopped today, it takes days to get these things, or weeks to get these refineries, due to the pressure requirements and, the amount of complexity that goes into this. These refineries take some good amount of time to get back up and running, that we have not even begun to feel the ramifications of it. Scary for sure. But these are all reasons why, prep, like you've talked about, reluctantly preparing for the unknown, for things that just come out of nowhere. And just seems that there's a lot of potential come out of nowhere type of issues surrounding us these days. But I think inflation will go much higher, and the byproduct of that is certainly a much less hawkish, far more dovish Fed. That, we want them to be dovish. It will be far more hawkish, rather, I should say. They want to be dovish. They want rates to go lower. It's not going to happen. They can't let that happen, or inflation is just going to get massively out of control. So it will be more of a hawkish Fed. At least it will be either a hawkish or a do-nothing Fed. But I think the market will have its pound of flesh on this and will push the longer-term interest rates on the 10-year much higher. I would expect much higher inflation, much higher interest rates leading into the end of the year, and that will not be bad for gold the way the conventional wisdom is telling you, because the underlying asset of U.S. Treasuries, I don't think is trusted anywhere near the way it once was. So people will forego that little bit of extra premium or interest that they could get in holding a Treasury, and the lack of convenience, like France bringing back their gold, like all the countries we've talked about before that, bringing back their gold from the New York Fed and the Bank of England to have no counterparty risk at the expense of great convenience, the LBMA and the COMEX. These things are happening, and I don't think it's anywhere near resolved yet, to be honest with you.
Before we move on, I wanted to get a chance for you to hit the weekly special so people can be aware of what we're making especially affordable this week.
1 ounce U.S. Silver Eagle, $5.75. Boy, that's the cheapest they've been in a long time. 1 ounce Silver Eagle, $5.75 over spot per ounce. 100 ounce Silver Engelhard bar, probably the most well-known silver bar in the industry. They were the first go-to name brand that I remember 35 years ago. $4.25 over spot. They're kind of collectors. Not really, you're not getting collectors premium. Some of them do, but they haven't been made in a long time, and they are the kind of the class of the 100 ounce bar category. And then MS62 $20 gold Liberty, $99 over melt per coin. That's going to put it under spot, real darn close to it. The coins are 0.9675, so they're a little under an ounce. Most of my career, though, done again, you would have always received substantially more than you would have, if it were, you're getting way over an ounce price. They were always valued at an ounce, even though they were a hair under, and now you're getting, you're paying under melt value or under spot price, just over melt value. From a standpoint of what I have known to be true for 35 years, that represents but a tiny fraction of the time that I've been doing this, where if you would have told me, most of my career that you'd be buying 62 $20 Liberties for under spot, just $99 over melt, I'd say you're out of your mind. In 2007 and 8, with $1,000 gold, I would have paid you $1,600 or $1,700 for as many of those as you would sell me, a 60 or 70% premium to spot. It's crazy how things change. So yeah, to me, those are amazing. I love those. I love the Silver Eagles. I love the Engelhard. It was one of the best specials we've had in a long time.
Yeah, because that's like 2% over the price of gold, like 2% over melt, which is unheard of for graded, slabbed and graded, professionally certified coins.
I mean, normally it costs $35+ to slab them. So you take that out, you're paying $65 over melt for a slabbed coin by PCGS or NGC. It's insanity. I mean, it's a pendulum where markets will swing too far to this side. They'll come through fair value and swing too far to that side. And we're too far over there. It doesn't make sense. But what this tells me is that this move we've seen in gold and silver, and that's why I focus so much on who's standing for delivery on COMEX and the central banks. They're the ones driving this and have been for a while. And that's the little man rule again. The big money positions themselves, skates to where the puck is going, like Gretzky, before the public figures it out. And you can see that. They've been very adept at doing all of this, as the public has just been misdirected into other areas and to other thought processes. It's perfect for the big money. So yeah, interesting times to say the least.
Well, Andy, thank you for making it back with us again this week. We're looking to get back with you again next week for another weekly market update.
I will be here.
And folks, don't hesitate to reach out. You certainly know how to reach us. At the bottom of the screen, it'll show you, and we'll be happy to help you obtain those specials. If you have any questions about any of the things that Andy's covered, feel free to reach out on that as well. Andy, as always, just thanks for joining us on Liberty and Finance.
Dear Class Act done again. Thanks for having me, buddy. We'll see you next week, and all the best to you and everyone else out there. Have a great rest of your week.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Monday, April 27th through Monday, May 4th, 2026, while supplies last. First this week, 1 ounce U.S. Silver Eagles are just $5.75 over spot per ounce, the lowest premium we've seen on Eagles in a long time. MS62 $20 Gold Liberties are just $99 over melt per coin. And finally, we will swap 3/9 fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.